Hi, I'm Martin McGrath from Financial Leadership, and we work with a lot of clients in regards to their rental properties to set themselves up for retirement. And one of the questions we often get is, how do I reduce the tax I've got to pay when I sell my rental property? And I always work with step one is understand what that capital gain is and what that tax is. And as an accountant, we step you through what we need to do to calculate that, and often I find a lot of people don't go through that process properly and or miss a lot of information. So I've got some other videos to explain what that process looks like, but once we know what that capital gain is going to look like, basically there's three things that we often work with clients about in a ways to reduce that capital gain. The first one is consider the timing of the sale of the property. Is it better to sell it this financial year? Is it better to sell it the next financial year in terms of when we do that in terms of timing? That might be timing of what the markets are doing, but also timing about what your personal finances are looking like. What's your income? What's your spouse's income? What else is going on? What other income you've got going on? Often timing it by a couple of days, a couple of months so that it falls in a different financial year can make a big difference. Secondly is if you've made a capital gain, particularly if we're approaching retirement, we want to look at putting some of that money into super. And there's ways basically with concessional contributions and catch-up concessional contributions that can reduce the tax you're paying in your personal hands, send that money into super fund and save yourself a lot of tax. So we did this for a client just a couple of months ago. They sold the property, they retired, they want to put some extra cash into super. They basically put about 20-30 grand in and saved themselves basically 10 grand in tax, and they're aged over 60, so they can access that money tomorrow. But purely by putting that money in, claiming it against that rental property sale has saved them a lot of capital gains tax. The last one, depending on the circumstances, is reduce the other income that you've got falling into that year. So it might be that if you're self-employed, you don't pay the dividends and trust distributions to yourself. It might be that you reduce your work hours because you know you've got a capital gain coming up, or you don't do the overtime. There's different ways potentially you can tweak what other income you've got in your tax return in that year, because that will depend upon what your capital gain is. So hopefully that's been helpful. There's a few hits and tips there. If you want to find out more, send in a message and we can have a quick phone call to let you know how we can help you.